What's up, guys? Welcome back to GTech Finance. My name is George, and today we're here for another video about the stock market. So it's no surprise and no doubt that the stock market has just this year during the pandemic just flipped upside down and has defied all odds and beaten all of our expectations. And it flipped so much actually that there's this article in Yahoo Finance that I'm only gonna say the title because it just sums it all up, that the weakest stocks are actually the worst stocks are the ones which are doing the best. And this is actually true because even though you have people that are investing in the real sense of the word, which is diversifying their portfolio, investing long term, or paying attention to the financials of the company before buying in it, and seeing how they can, and buying any sort of investment, whether it's real estate, stocks, and I said it again, diversifying their portfolio as much as they can. And actually, what we can see is that new data has found that since the announcement of the vaccine on November 6th, the stocks with high short interest have almost doubled the performance of stocks with low short interest. Or in other words, the stocks that most people think are going to drop are the stocks that end up going up the most in price and surging. They even go so far that investors have been rewarding just junk and disappointment. The thinking is that maybe investor expectations are so high right now that if a company doesn't completely blow it up and crush everything and kill it, and it goes just beyond our wildest dreams, the stock price goes down because it's not what they expected. It's almost as though the bar is set so high that the possible outcome is already priced in. So once good news comes out, people begin to sell off and the stock comes back down. And because what else is there to look forward to if the news were already priced in? However, economists caution that this behavior could be a sign of something far more ominous. Valuations are growingly detached from fundamentals, which is exactly what we saw with the GameStop case, which today is having right now a hearing with the CEOs of Robinhood, Melvin Capital, Citadel, and the user of Reddit, Deep Effing Value. And as CNN says, market euphoria is everywhere. Low interest rates are causing investors to search for even higher returns. And with optimism of an opening economy, there's almost the expectation that it's impossible to lose money anymore. But we should really talk about why this is happening in the first place and then what you can do about it. First, stimulus. So every day almost, I've been making updates on the $1,400 third round of stimulus checks. And I'm gonna do it quite quickly this time. Also, we still have Joe Manchin and Kristen Sinema being the key to this bill. And it's really similar as yesterday. We still have neutral parliamentarians. We're gonna wait to see what are they gonna say and rule with the $15 minimum wage. And like Joe Manchin said, if the parliamentarian lets it pass, he's gonna go for it, and if they don't, he won't. And Kristen Sinema is still silent, and we've yet to know what's gonna happen with him. But I think that the Fed's lowering of interest rate and massive stimulus packages were necessary in keeping our economy afloat, but no surprise, it threw the markets out of whack. When airlines and cruise lines received billion-dollar bailouts, 25 billion, 30 billion, 50 billion, it really begins to distort the market in terms of how much the company should be valued or it should trade at. Second thing is margin. With low interest rates, people are encouraged to borrow more money, and frankly, it's fairly normal. It can be done responsibly, but a lot of people forget the risks that you're borrowing money to buy an investment, and you're not even sure the investment is going to work. If it doesn't work and it goes down in value, then you've got debt. And now the interests are low, but if they go back up, you'll have a debt with higher interest. Third, why the worst stocks are doing the best. Right now, I think a lot of people are looking for the next big opportunity. We've seen companies like Zoom just go 5x instead, and they just trade on momentum and excitement. It seemed like every other week, and it still seems like that, there's another new stock that people begin talking about online. People buy in, drive up the price, and then it comes crashing back down as soon as everyone moves on to the next thing and attention from the media goes away. Like it happened with EVs, Tesla and NEO, then with Bitcoin, and now with Doge. And this is when this opens up our fourth point, meme stocks. This is a brand new type of investment. People don't trade with meme stocks on the fundamentals or technical analysis or even news, but instead they just trade on momentum and excitement. And this is exactly what we saw in Doge. We saw Elon Musk tweeting about it, and the price would just surge 1500%, and the moment the attention of the media goes away, it comes back crashing. Fifth is the news. Right now, the attention is moving the markets, and more than ever, investors are growing impatient when nothing happens. And sixth, there's absolutely the gamification of stocks. Thanks to apps like Robinhood, Webull, or maybe even M1 Finance, but especially Robinhood, it lately seems to me like the line is really getting blurred between investing and gambling. And in a market where it seems like everything keeps going up, it's going to reinforce that investing is easy, and anything below a 20% return in a month is bad. While actually the S&P 500 index fund has an average return of 7 to 10% depending on the year. This is an exception in the year, so it was a bit more because of tech stocks reaching all-time high after another, and after another. But that's led to this new psychology that people may as well take the risk with really poor performing companies because they have way more upside than something that's already at its all-time high by a whole lot. But I would say this, just because this can work now, like we saw with GameStop and AMC, with GameStop having fundamentals completely outdated and AMC as basically a closed theater, it doesn't mean it always will work, and none of it is sustainable. Clearly, this is not investing at all. And so, hopefully, and the thing is, maybe we need this crash because it's a way to just clean up the market again. A lot of stocks were inflated, and I even sometimes think Tesla is one of them. And it's just an example. And if it cleans it, and now we have, of course, CCIV, Churchill Capital Corp, that is really going to the moon. It's almost 10% a day. I'll make a video about it soon, but I think that's enough for today. If you appreciated the video, hit the like button, subscribe to the channel. It will help us massively, and see you guys next time.